Welcome back to What's Hot and What's Not in CRE, your daily pulse on commercial real estate in America. I'm your host, Rachel. Today we're wrapping up the week with the big picture. Where is institutional capital and smart money investing in 2026? Let's dive in. So, what's hot? First and foremost, private real estate allocations are surging. We're seeing a massive shift, with a recent survey showing 82% of wealth managers plan to increase their allocations to private real estate over the next 3 years. They're not just throwing money around. Capital is flowing strategically into closed-end value-add funds, separate accounts, and club deals, all designed to exploit the current pricing dislocation. The opportunity is now. Number 2, and this will surprise no one. Data centers are the top play. They are consistently ranked as the number 1 property type for 2026. The demand is simply staggering. In 9 major U.S. markets, 100% of new construction is already pre-committed. This is driven by the insatiable needs of AI, machine learning, and cloud computing, giving landlords unprecedented pricing power. Next up, the darling of the last few years. Industrial and logistics remain incredibly strong. E-commerce, the onshoring of manufacturing, and the need for supply chain resilience continue to fuel demand. But smart money is getting more granular. They're differentiating between big-box logistics hubs, crucial last-mile infill facilities, and specialized high-demand assets like cold storage with its very sticky tenant base. Of course, we can't forget housing. Multifamily and rental housing stay resilient. The math is simple. A constrained housing supply and elevated mortgage costs are keeping people renting for longer. The focus is squarely on Sunbelt metros, essential workforce housing, and the booming build-to-rent sector, especially in areas where the supply gaps are most acute. And finally, a hot area that might be less obvious. CRE debt is a huge opportunity. With traditional banks pulling back, new CRE loan volume from alternative lenders is up over 90% year over year. Spreads have tightened by 183 basis points, and CMBS volume is up 110%. Capital is moving into the middle of the stack. Mezzanine debt, preferred equity, and B notes to capture equity-like returns, but at a lower risk profile. It's a savvy move in a cautious market. Now for what's not. First, generalist strategies are out. In this market, expertise wins. Institutions are favoring sector specialist managers who live and breathe data centers, life sciences, or last-mile logistics over the broad, a little of everything, generalist funds. Second, commodity office space is still very much struggling. Smart money is barbelling its office exposure. What does that mean? They're either buying trophy Class A buildings in prime locations, or, on the other end, picking up heavily discounted, obsolete buildings for conversion plays. Everything in between is getting passed over. Similarly, Class B and C retail remains underallocated. Functionally obsolete strip malls and aging retail centers are seen as redevelopment targets at best. Capital is only flowing to necessity-anchored formats, grocery-anchored centers, and experiential retail that can draw consistent foot traffic. And lastly, high leverage is out. The days of cheap, abundant debt are over. Sponsors are now targeting lower loan-to-value ratios with fixed or hedged debt. We're seeing more preferred equity and creative earnout structures being used to bridge the bid-ask gaps. Conservative capital structures are the new standard for getting deals done. That's your investor outlook for 2026. The theme is clear. Selective, thematic investing that revolves around game-changing trends like AI, shifting demographics, and the persistent housing undersupply. Thanks for tuning in, and thanks for a great week. See you Monday.